What if the single most important theory in modern finance, the one taught in every business school, the one used to justify how trillions of dollars are invested, is a lie? For decades, they've told you the market is a random walk. Imagine it like this. Every day, the market flips a coin to decide if a stock goes up or down. They've preached that all known information is already baked into a stock's price, making it impossible to consistently beat the market. It's called the efficient market hypothesis, and it's the foundation of the entire index fund industry. The message is simple. Don't even try. Just buy everything and accept average. But if that's really true, how did Warren Buffett become one of the wealthiest people on Earth? How do entire firms, year after year, manage to crush the averages? In this video, I'm going to show you the cracks in this theory. We won't just question it. We're going to look at the hard evidence, the market anomalies that prove this whole idea is fundamentally broken. These are the predictable patterns that Wall Street's biggest theory says shouldn't exist. But they do. And for those who know where to look, they create massive opportunities. So before we can tear it down, let's understand the official story. The efficient market hypothesis, or EMH, is an elegant idea from the 1960s. It says that financial markets are informationally efficient. Think of the stock market as a giant, hyper-intelligent sponge. The moment any news drops, an earnings report, a product launch, a lawsuit, millions of smart, well-funded investors instantly react. They buy or sell, and in the blink of an eye, the stock's price absorbs it all, leaving no drops of secret information left for you to find. So, what does that mean for you? It means trying to find an undervalued stock is like trying to find a secret message on a billboard in Times Square. Any information you think you have, thousands of others have already seen it and acted on it. Trying to pick winning stocks is like trying to win a coin flipping contest. You might get lucky a few times, but over the long run, you can't have an edge. Your path is just a random walk with no predictable direction. They even have levels to this theory: weak, semi-strong, and strong. The most common version, the semi-strong form, says you can't beat the market using any public information. It's a powerful idea, and it's why so many people say to just put your money in a low-cost S&P 500 index fund. Even Warren Buffett himself has said that for most people, an index fund is the best bet. But notice his choice of words, most people. He never said it was impossible. In fact, his entire career is probably the single greatest piece of evidence against the very theory he seems to support for others. If the market is so perfectly efficient, how do you explain the patterns? How do you explain the glitches in the matrix that show up time and time again, in one study after another? This is where the idea of perfect efficiency completely shatters. The truth is, the market is mostly efficient, but not perfectly efficient. Think of it like a brand new car. It's a high-performance machine, but it's not perfect. It still has blind spots, and the gap between mostly and perfectly, those blind spots, is where fortunes are made. These imperfections are called market anomalies. They are predictable patterns in stock returns that directly contradict the efficient market hypothesis. They're the ghosts in the machine, and they prove the market isn't just a random walk. It has habits. It has tendencies. And most importantly, it's driven by something the theory totally ignores: human beings. The first and most famous anomaly is the value effect. This is the core idea that made Benjamin Graham and his student Warren Buffett legends. The idea is shockingly simple. Stocks that are cheap compared to their business fundamentals, like their earnings or cash flow, tend to outperform expensive growth stocks over the long run. It's like finding a brand-name winter coat on the clearance rack in July. The quality is still there, but the price is low because it's out of season. If the market were truly efficient, a cheap stock would be cheap for a good reason, and an expensive stock would be worth its high price. That winter coat would never be on sale. There shouldn't be any systematic advantage to buying one over the other. Yet, for decades, the data has shown otherwise. Buying good companies at bargain prices has been a persistent, market-beating strategy. Buffett famously mocked the EMH, comparing its believers to a flat Earth society. He said, "Ships will sail around the world, but the flat Earth society will flourish." There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. Of course, value investing doesn't work every year. There have been long stretches, like in the 2010s, where growth stocks crushed it. But these things are cyclical, like seasons. For example, in 2022, when high-flying growth stocks crashed hard, value stocks held their ground far better. The very existence of these long, powerful cycles between value and growth is proof that prices aren't always rational or efficient. They are often driven by fear and greed. Now, let's look at an anomaly that seems like the total opposite of value, but it also blows a hole in the EMH. It's called the momentum effect. The principle is simple. Winners tend to keep winning, and losers tend to keep losing. Think of it like a snowball rolling downhill. A stock that has done well over the past 3 to 12 months has a real measurable tendency to keep picking up more snow and getting bigger as it continues on its path. According to random walk theory, this is impossible. A stock's past performance shouldn't have any bearing on its future. That snowball should just randomly stop or change direction. But the data is overwhelming. Momentum is one of the most robust market anomalies ever discovered, and it's been found in different countries and even different asset classes. So why does it happen? Human psychology. When a stock starts rising, it gets attention. People get FOMO, the fear of missing out, and they pile in, pushing the price even higher. On the flip side, bad news can cause an overreaction, leading to drawn-out selling pressure. The market doesn't instantly price in information. It often reacts slowly and then overreacts, like a single person starting to run in a crowd, causing a full-blown stampede. This isn't a foolproof strategy. Momentum can lead to spectacular crashes when the trend flips, like in 2009. But the fact that this predictable pattern exists at all is another nail in the coffin for the efficient market hypothesis. It proves that market prices are driven by human behavior, not just pure information. Finally, let's talk about the human factor, which shows up clearly in calendar anomalies. Predictable patterns tied to specific times of the year, month, or even week. The most famous is the January effect. For decades, studies showed that small-cap stocks, in particular, tended to pop in January. The most common explanation is tax loss harvesting. Think of it like a store having a huge end-of-year sale. Investors would sell their losers in December to get a discount in the form of a tax deduction, pushing prices down artificially. Then in January, the sale is over and they'd pile back in, often with their year-end bonuses, causing a rebound. Now, full disclosure, the January effect isn't what it used to be. It has weakened significantly. It was like a secret traffic shortcut. Once everyone learned about it and started using it, it became just as crowded as the main highway. The rise of tax-sheltered retirement accounts also meant fewer people needed to sell for tax reasons. This is a perfect example of the market adapting. But the fact that it existed so strongly for so long proves the market isn't a sterile, perfectly logical machine. It's influenced by tax codes, bonus schedules, and human psychology. Other calendar effects, like the Monday effect, where stocks historically did worse on Mondays, also point to this same human element. This is the ultimate flaw in the EMH. It models the market as a collection of perfectly rational robots. But we aren't rational. We're emotional. We're driven by fear, greed, hope, and despair. As Warren Buffett's partner Charlie Munger says, the efficient market theory is a wonderful example of a theory that is approximately right, but not right enough to be useful. He dismisses the academics who cling to it, saying it's better to add a sigma than change a theory. So what does this all mean for you? First off, it does not mean that beating the market is easy. It's not. If it were, these anomalies would be traded away instantly, just like that traffic shortcut in the January effect has mostly faded. But it does prove, without a doubt, that beating the market is not impossible. The efficient market hypothesis isn't a law of physics. It's a theory, and a flawed one at that. It's a useful concept, but at the end of the day, it's a half-truth. The market isn't a random walk. It's a game of probabilities. By understanding these anomalies, the power of value, the psychology of momentum, and the emotional tides of human behavior, you can start to put the odds in your favor. The small, patient retail investor actually has an advantage here. You aren't managing a billion-dollar fund that has to move like an oil tanker, taking miles to change course. You can be a speedboat, zipping around and seizing opportunities the big guys are too slow to catch. You can wait for what Buffett calls the fat pitch when Mr. Market, in one of his foolish moods, offers you an obvious opportunity. The lie of market efficiency is designed to make you passive. It's designed to make you think you're powerless. But the evidence shows something else entirely. It shows that for those willing to do the work, learn the patterns, and think for themselves, there are always opportunities. If you want to learn more about finding those opportunities and challenging Wall Street's conventional wisdom, make sure you subscribe and hit that bell so you don't miss what's next. And let me know in the comments, what's another market rule you think is meant to be broken?